All right, everyone. Good morning and good afternoon. Thanks for joining our webinar, Stablecoins and Blockchain, Regulation, Fraud Risk, and Decentralization. We're first going to go through if you just want to go to the next slide. We're first going to go through some housekeeping items, and then we'll have our webinar led by Kamal Hubbard and Hao Lee. Kamal is from Cage Chain Media Group, Hao from DataVisor, and then we'll follow with a Q&A session. This webinar will be recorded. A link to the recording is going to be sent to everyone in attendance. And as I mentioned, we will have a Q&A session at the end, so please be sure to submit your questions on the panel on the side of your screen. Any questions we don't have time to cover, we will follow up with at the end of the event. If you want to continue here. And now I'm going to hand it over to Hao Lee from DataVisor.
Hey everyone, good afternoon, good morning. This is Hao Lee with DataVisor. I've been with DataVisor for 8 years and I am the Chief Solution Architect of the company. We have been supporting many customers in leveraging the DataVisor fraud and risk management platform and solutions to enable FIs, including banks, fintechs, credit unions, to respond to fraud attacks in real time and stay in compliance from an AML perspective. So today I'm very pleased to have a very special guest joining us in this webinar, Kamal. Kamal comes from a very well-known online education community for the DeFi topic. Kamal, you want to give an introduction about yourself?
Yeah, thanks, Hao, and thanks, DataVisor, for having me for this webinar. My name's Kamal Hubbard, and I am an author of 3 books on decentralized finance, blockchain, and cryptocurrencies. I've also advised a number of companies over the last decade that I've been in the industry, and it's been fun and interesting, and only getting more interesting and fun. So, looking forward to today's webinar and having everybody alongside of us in attendance.
Thank you, Kamal. So I'll move to the section so we can get started on the background part, right? So let's give the audience some background about this overall stablecoin topic, the regulations and the trends in this area. So let me know if you want to skip to the next slide.
Okay, thanks again, Hal. So we're going to start out with a poll here for everyone's understanding of stablecoins. What stablecoins is everyone here familiar with? We have a list of 5 here, and select all that apply, please. All right, looking at the results here, the overwhelming majority of folks are familiar with USDC. Second to that is USDT, USDS. Good number of folks know about that. USDE and DAI. So these are the top 5 stable coins by cryptocurrency market capitalization. So, and actually USDT has a higher market cap than USDC, but it's good that everyone is aware of both of those. Next slide, please. All right, so just to set the stage for today's webinar, we're going to cover a few terms, including that of Web3, decentralization, Bitcoin, and stablecoin. So Web3 is the next generation of the internet, creating a decentralized web through blockchain technology, allowing for greater privacy and ownership of data. Decentralization, a term that many of us have probably heard about, is the distribution of control and decision-making away from a central authority. Bitcoin, which is the #1 cryptocurrency by market capitalization, was introduced in 2008, and It is a decentralized digital currency created for use in peer-to-peer online transactions. And lastly, what we're talking about here are stablecoins. A stablecoin is a type of cryptocurrency that aims to maintain a stable value relative to a specified asset, a pool, or basket of assets. And so to look at how stablecoins have grown, actually in recent years, looking at the total market capitalization of stablecoins, we're looking at somewhere between 310 to $314 billion. And it surged in growth by 50 or almost 50%, 49% to be exact, last year in 2005. And as I mentioned previously, USDT Tether is the number one stablecoin by market capitalization. All right, so one of the biggest pieces of legislation to pass Congress is the Genius Act. And the Genius Act establishes licensing rules for US stablecoin issuers, as well as set standards for foreign issuers operating in the United States, along with clarifying the roles between the SEC and the CFTC when it comes to oversight of digital assets, and creates clear compliance pathways for stablecoins, DeFi, and smart contracts. Now, a cautionary tale of stablecoins is that of Terra, Luna, and UST. So Terra was and still is, but it's an open source blockchain that had a native token called Luna. And this ecosystem introduced an algorithmic stablecoin called UST. And UST aimed to maintain a $1 peg via algorithms versus real US dollar fiat reserves. So unlike UST and USDC, it relied on market incentives versus real dollar backing. Unfortunately, UST collapsed due to an algorithmic failure that created a breaking of that $1 peg for UST, which actually sparked massive panic for Luna. So the price of Luna collapsed, and somewhere between 45 and $50 billion in market capitalization was wiped out in a matter of days. And so this shows that lack of external backing accelerated the collapse because, once again, people were panic selling Luna. And this also demonstrates how algorithmic stablecoins can fall to zero very quickly. So let's talk about some decentralization red flags. So one of the benefits of decentralization is that of transparency. And the way that the tools that we can use to have a more open and transparent internet through blockchain are a tool called the Blockchain Explorer, and it provides real-time visibility into on-chain activity where transactions are publicly observable on distributed ledgers. And however, sophisticated actors can use protocols and anonymity tools to obscure the flow of cryptocurrencies. And it's through this obfuscation that we're able to see patterns of illegal activity, including money laundering and trafficking. So through the use of blockchain explorers, you're able to see signs of anonymity tools called mixers, as well as no KYC exchanges. Mixers are an automated protocol tool that helps break the direction or the direct connection between where crypto is coming from and where it's going. So it basically allows nefarious actors to cover their tracks to a certain extent by mixing a bunch of coins at once. And whereas with no KYC exchanges, these are cryptocurrency exchanges that facilitate the trading of digital assets with maximum privacy and minimal hassle by not requiring trader identification credentials. Despite many of these exchanges limiting the amount that can be traded to avoid money laundering, they are often utilized to avoid direct tracking of crypto. And some of the fraud schemes that arise through the use of cryptocurrencies and stablecoins are that of affinity fraud. And, when we're talking about cryptocurrencies, blockchain, decentralized finance, we're talking about trustless and permissionless systems. However, there may be a knowledge gap between certain users of crypto where as long as someone knows a little bit more than someone else about the technology, they can gain trust. And so this allows people to target trust or target communities and gain trust through shared identities. And so these affinity fraud schemes exploit those relationships by leveraging that credibility and social trust. And where we see these schemes that often appear are through religious and ethnic groups, veterans, senior citizens, and other professionals as well. So essentially, trust is weaponized before money moves.
Thank you, Kamal. That was a very, very educational session for us to learn about a lot of the key terms and also the trends in the industry about the whole DeFi, especially come to stable coins. And yeah, so next section, we'll be talking about some of the case studies that from DataVisor's customer base or from our experience. DataVisor, as I mentioned earlier, we provide the platform and solutions for the FIs to handle a lot of the fraud activities and the fraud attempts in this ecosystem. Some of our customers, they are the larger crypto exchanges where we are helping them to look at the fiat to the crypto on-ramp process to try to stop fraud from happening before the money move into the chain. Some of the customers, they're not crypto exchange. They're banks, they're fintechs who provide digital wallet for customers to actually hold the crypto, purchase crypto, and maybe use it to check the crypto trading market there, provide insight as well. So in next section, we're going to look at some of the case studies that we have seen from these possible use cases and how we can all prepare each other, prepare ourselves, right, about those possible attacks, possible fraud schemes, anti-money laundering knowledge that we should embed into our day-to-day when it comes to stablecoin and the fiat to crypto on-ramp processing. So before we go into the specific case study, we'd love to host the second pool of this webinar. This is to try to get a little bit more background from our audience. We are seeing a lot of the users of our platform. They're either from the fraud team or from the compliance or anti-money laundering team. So we'd love to know if you're coming from one of these two teams, or maybe both, right? Please let us know. And then we can use that to kind of gauge, right, which part of the use cases could be more interesting in our talk today. This is a single choice question. So if you're on both, then maybe other team or pick the one that you're primarily responsible for, please. Okay. Let's take a look. So we have about half of the responders are coming from the fraud team, and about half are also like 40% coming from other teams, and about 1/5 are coming from the compliance team. Thank you. Thank you for letting us know about your background. We do have both some of the fraud use cases and the compliance related use cases and suggestions to share today. So we're going to cover both. Yes. So the first one, before we open up the topic about these case studies, I want to maybe mention a few um, stages in the digital wallet or the crypto or the stablecoin transaction. So for a digital platform or crypto exchange to enable a user to purchase stablecoin, there will be a pre-transaction flow here that we all have knowledge about. For example, a user needs to sign up first. Once the user sign up, hopefully the platform goes through the KYC process to know about the user, know about the customer, gather the necessary documents like driver license, DOB, and maybe address, all those KYC information to try to validate that as a real user, and that identity itself is a legitimate identity that we can do the trading with, right? They're not on the OFAC list, they're not on those sanction lists, right? So that would be the basic KYC and compliance sanction list checking. And that completes maybe like the user onboarding flow. Once the user is onboarded, then the user can link a external bank account typically to try to move the money from the external bank account onto the trading platform. So he or she can use the money to purchase crypto coin, including stablecoins. So that is what we call the funding process of the digital wallet from external bank account. And this is where a lot of the fraud could happen. And once the money is settled in the digital wallet after that funding step, then the users can start using the money or the balance in the digital crypto wallet to purchase the coin. And once the coin is purchased, they're already on the blockchain, then a lot of the fraud patterns, a lot of the risks is what earlier Kamal mentioned, right? That would be the on-chain analysis. There will be a lot of the blockchain explorer that can help us visualize to try to understand the transaction flow that are happening on the chain. So here, from a data advisor perspective, we have been trying to put the mission in helping our customers in this use case as how can we know the fraudsters early and how can we stop those transactions as early as possible before the money go into the chain. Once it's on the chain, then a lot of those mixer, a lot of those techniques, right, make the detection to be 10x more difficult if it's already on the chain. So here we are focusing on the fiat to the crypto, what we call the bridge stage attack, and how can we have a few scenarios, a few defense mechanisms to try to equip ourselves as much as possible in that bridge stage. So the first one here I want to talk about as a case study is a very famous one, and I think all the banks, all the fraud team at banks, right? We talk about these terms a lot. It's called ACH kiting. Basically, ACH transaction is a transaction type that is not real-time settled. It typically involves 1 to 3 business days actually to get the whole transaction settled. So if I link my bank account to my trading platform and I move money into my trading platform from that bank account, I technically need to wait for 2 to 3 days before the money fully settled in the crypto in my digital wallet. But the platform, they want to promote better user experiences. So the platform sometimes says that, hey, as long as you verify that it's your account, and as long as you start to move the money in, we want to enable you to trade right away. So the platform are generous enough to give part of the funding immediately available. So that enable the users or sometimes enable the fraudsters to do something shady there. So I can initiate the transfer to be $1,000 and the platform says that, okay, how fine, let me give you $500 that is available right now. Just like when we deposit a check, the bank typically give you a small portion of that to be available immediately. Then I can use that money to trade, to buy coins, and the coin is already on the blockchain. But in the meanwhile, I can go to my bank, I can move the money out, and when the actual settlement is attempted for my ACH funding transaction, my bank will send an ACH return. Typically, it's an R01 return back to the trading platform. Hey, house account doesn't have that much money. There's no $1,000 to move in. So at that point, the platform will feel like, oh no, but Hao already used the $500 to buy coins already, and he might already cash out somewhere else. So that's what we call the ACH kiting fraud. It's a very classic fraud that is not unique to crypto. ACH kiting fraud can happen for all the other types of ACH-based transactions as long as there is a early availability decision about the fund. So here, as a bank or as a fintech, as a credit union, your business pain point here is your direct credit loss. You're basically crediting the dollar to the user to allow them to do the transaction earlier before the fund settled, but now they're lost. So you need to go through all your recovery, you need to go through all your ACH chargeback handling with the counterparty bank, but the fraudster, they already got the money. Basically, to them, this is the free money that they can use to buy coins and cash out somewhere else. So that's about the ACH kiting scenario that I applied into this fiat to crypto bridge stage. The next case study that we would love to talk about here, it's based on account takeover. In short, it's called ATO. So if the legitimate users, right, we have money available in our trading account or the digital wallet on the trading or the crypto platform, but those funds sometimes could be taken over, could be compromised if the fraudsters, they compromise my trading platform account. So it could be social engineering, it could be scams that could get me into giving out my information to the fraudsters, or the fraudsters, they don't even ask me, right? They don't even scam me. They use bot, they use brute force techniques to try to hack into my account. And once they hack into the account, they can see the funds are available in my digital wallet. Then they can start leveraging the transparency or maybe the anonymization nature of the blockchain to try to money out. So they could move the funds into layers of new wallet on the chain. They could purchase stable coins, and then they can do those layering techniques to move the money out ultimately to their own wallet somewhere else on the chain. And then they cash out from there. So once the money is on the chain, it's rather difficult to get it back. So that's why here the account takeover protection becomes the key to prevent such type of attack and the money loss. So for the FIs, the business pain point here is that there's no clawback. This is irreversible loss. Once the fund hit the chain, then the dollar is already gone. So if I, as the legitimate user, call my platform, hey, where's my money? My account is hacked. Then the platform has to pay the money back to me. So here it's more of like a customer dissatisfaction, while there's also a big financial loss here for the bank to recover the cost for the user. In case study number 3, we're going into some of the more advanced techniques that are not based on basic social engineering or scam. This is more of like typically a bot-based attack scheme, and it's ultimately ending in the form of promotion abuse. So promotion abuse happened because a lot of the digital platform want to incentivize new users to sign up and to move the money in. So that's why there's usually some of these new user bonuses. If you sign up, then you can get $50 for free, right, to trade on our crypto platform. If you refer a friend, then you can get $50 more, and your friend can get $50 himself or herself too. And that propagation is what the platform used to try to get the new users signed up. And that is where the fraudsters, they smell the money. They could use a series of these attack techniques, for example, the bot automation, the bot farm, the phone farm, right? All those techniques are very popular out there for the fraudsters to use programmatic methods to scale up these attacks. They can sign up an account and then they can do the whole propagation of this referral network using bot account, and they can get basically these are free money for them. If each account can get $50, they purchase stablecoin immediately, and then they combine the coin on the chain and harvest that into their own wallet somewhere on the chain. So that's why this part is something that a lot of the new fintechs focusing on growth, attracting good users, hoping attracting the good users, but it actually get a lot of the bot accounts signed up. Here later, we're going to talk about how we can have some techniques, maybe some defense mechanism in the onboarding process and the KYC process to try to prevent your marketing budget, try to prevent your CAC, right, your customer acquisition cost to be inflated, and your operating and the marketing budget being wasted into these bot accounts, which are the business pain points typically for the platform in this use case. Cool. Our last but not least case study for today's sharing, it's not from the fraud perspective. It's more from a compliance perspective for the anti-money laundering team here. So since stablecoins hold the value quite stably, right, as it names, and since the blockchain, right, the nature of the blockchain help to hide the transaction flows, hide the money flows using those techniques like the mixers, these two combined is almost like a perfect way for money launderers to leverage to try to wash the money, to launder the money. That's why criminals, they can create a lot of new accounts at the FI and they put small dollar of dirty monies in. It's $10, right? Tens of dollars, hundreds of dollars, small money that is sneaking under the radar or for the policies, maybe the fraud rules. And then they move all those small amount of money, but a lot of those transactions happening in a very well-designed network or the Mu networking layering system. So they combine the funds and they even can swap for different types of stable coins, right? They use the mixers technique like Kamal earlier mentioned, and then they can use it as a super effective way to launder the money. This almost is like a music to the money launderer once they hear the advantage of the blockchain in that sense. So that brings huge regulatory fines and reputation risks to the FIs, and you become the placement stage of a lot of these money laundering operations. And on paper, you're going to feel like, oh, I have so many new users. They're making a lot of transactions. We have very highly active users here, right? On paper, a lot of those might looks like good growth metrics for the company, but it comes with a lot of these reputation and regulation risks that we do feel like leaders here should be aware of, right? This is a double-sided sword. We have to understand the risks, especially when it comes to compliance risks of enabling the users to trade stablecoins on your platform. And Kamal, if we have time, maybe you can also mention a little bit about the TD Bank case, right? Where that was the headline, right, for a period of time about the whole stablecoin industry here.
Hey, refresh my memory on that one. Is this recent or with TD Bank?
I think it's 2024-ish, 2024, yeah. Yeah, it's okay. Maybe at the end, if we
Okay.
have time in the Q&A session, we can talk more about that. I saw some customers and also some DataVisor customers, right, and also some audience here on the line. And we actually are curious about what are the more famous, right, big fine, right, that are issued to the large names, right, the banks about stablecoins.
Yeah, I mean, there's so many cases, especially over the years that I've seen and read, and now with greater adoption of crypto, we see these headlines every day now. So it's not just the very big multi-billion dollar graphs that are taking place. It's pretty much like I said, it's getting daily coverage, and we're seeing bad actors really all over the place. And honestly, there's been so much going on lately, especially with new regulation and new administration as well, and just a new approach. So, unfortunately, I do not remember the TD Bank case.
No worries, no worries. Yeah. So with that, right, maybe we can move to the next session. So at this point, the audiences, you might feel like, hey, seems like this thing is so risky, right? Should we even think about adding that to our product lineup, right? How should we handle all these risks? So no worries, right? We have experts like Kamal, right? We have DataVisor platform and some of the other platforms, our peer, right, partners in the ecosystem that provide a lot of techniques and solutions to mitigate those risks. while you can still grow your business, right? And make your customers happy by providing this new and powerful capability of the trading platform. So next, let's talk about some of those defenses that we can think about deploying before the whole big adoption, or what we call the boom, right, of stablecoin comes to the mainstream mid-size, large size, and the smaller size banks in the United States. What we call the left of boom defense techniques. So the number one suggestion from DataVisor is to get into the risk checkpoint as early as possible, what we call the on-ramp check. Basically, when the user sign up, typically there's a time period between the sign-up time and the actual first transaction time, like I earlier mentioned. So the onboarding, the KYC, the account linkages, external account linkages with the external bank, and then the funding process to fund the digital wallet from the money in the external bank. A lot of those are great risk checkpoints for you to get to know whether that user is worth having the stablecoin trading capability. Onboarding KYC, that stage is where earlier Kamal mentioned some of the trading platform, if they don't emphasize enough about getting the KYC signals, if they don't do their due diligence to use some reliable KYC sources to try to know, hey, if that name matches that address, is that even a real address? Is that email looks like a bot gibberish email, right? If they don't do those due diligence, then they're losing a lot of the useful signals in that stage to catch the fraudulent account at this stage. And even if they pass the KYC stage, the account linkage, right? You can verify the account it's actually owned by the user in the external bank. You can verify the account balance. You can even try to do some protection about your fund early availability strategy there to allow for only a very small portion of the fund to be available, or even no fund is available until the whole ACH funding transaction is settled. So you have a lot of chances and moments there to define and defend your system, but still make the user feel like they're being powered by this trading capability. So a lot of those is what we suggest as velocity checks, right? Bot detection, KYC checks. That would be the networking velocity detection that you can happen even you don't know what they're buying. Even though you don't know how much they're going to spend on buying stablecoin, you can do a lot before that. That was our first suggestion. The second suggestion comes into the digital wallet onboarding itself. So when you gather all these signals, then you have a lot of signals from a lot of users. A lot of them, they are not your existing users. They're new users that are coming, signing up just for the stablecoin trading capability. Then you need something as a powerful engine or networking engine to try to link all these signals together and to detect what are the possible mule farms, mule accounts, bot accounts that are happening in that good user, like in that good user growth metrics numbers. So here, DataVisor, we actually provide our very proprietary and industry-leading unsupervised machine learning algorithm. This is our proprietary technology that can detect this fraud ring, these mule forms in real time. So when they sign up, you can see that account belongs to whether it belongs to existing fraud ring or mule forms, and you can get real-time scores, real-time reasons, real-time detection rationale signals back to your platform, so you can have much more leverage in mitigating the risk, right? You can have your customer to do maybe soft KYC, maybe KYC step up, KYC level 2. You can maybe have your customer service team call out. A lot of those techniques can be leveraged for you to mitigate the risks once you know the big picture. This is to help you get the big picture rather than looking at individual account one by one. Our third and the final suggestion in this session, it's about using graph analysis technique. There are a lot of technology out there that can help you visualize this big picture that we earlier talked about that were detected from step 2. So your customer service team and your fraud team and your compliance team, right? They need to see the big picture and visualize it. They need the story, they need the narrative to know, oh, that account is actually linked to 4 more accounts by IP address. another 3 accounts by email address. So it seems like there's something going on there. Let me take a screenshot, right? Let me download this report about the graph, and then let me show it to our compliance team. That's why we reject that account. That's why we should not do business with this user. So knowledge graph is what DataVisor provides as the product to help you visualize all these detected linkages, subtle linkages among all these risky actors. And we hope that this help you to maybe file more convincing compliance report, and a lot of the customer friction handling can be supported by this knowledge graph if you have the full narrative about the story. Okay, so that's pretty much it. I know there are some questions coming up, but maybe we can hand it over back to our host Josh first, and then we can see how much time we have to take some questions before we wrap up. Josh.
Yeah, thanks, Hao, and thanks, Kamal, as well. It was a great presentation. It's time for Q&A right now. If you haven't submitted your questions yet, please be sure to do so. We'll have plenty of time to go through them. Anything we don't, we will, cover, and we can follow up over email. I do want to call out, before we go into questions, I'm excited to share our next month's Defend webinar, Fraud and AML Executive Insights for 2026. I'm putting the registration link in the chat right now. We'd love to have you all there. We're going to have a great panel set up, so hopefully you can join. So with that being said, let's head over to some questions. Come on, Hao. Feel free to take these as you wish. The first question that we have here is algorithmic stablecoins were mentioned earlier. How many other types of stablecoins are there?
Sure. So some of the other types of stablecoins are crypto-backed, where, as mentioned earlier, it's taking a basket of crypto, including things like Bitcoin, Ethereum, and other stablecoins to maintain a certain price, as well as stablecoins that rely on the price of a commodity like gold or silver or anything, any other commodity essentially. So Pax Gold comes to mind as a commodity-backed stablecoin.
Great, thanks, Kamal. Next one we have here is it seemed that in the case of Luna, you did a quick read on the description. It was pegged to USD, but it really was not. Is it clearly stated that they are algorithmic stable coin versus reality backed by USD or another currency?
Sure. I do not recall exactly what the documentation was for the formula for the algorithm of UST. I know that it was supposed to essentially mint UST at a $1 price based, and a lot of that relied on the price of Luna. So, sorry, I'm unable to answer that question as clearly as I would like. But from what I recall, that algorithm would take mainly Luna to prop up and set that fixed price for every UST.
Got it, Kamal. Thanks. Next question we have here is what accountability do stablecoins have to prevent criminals from using their platforms to commit ACH fraud?
Well, something, if I could chime in here, that I do know is, you know, through this regulation that is coming through Congress, some of these issuers are going to look to, uh, you know, freeze certain funds that belong to people who are engaging in nefarious activities, or also send funds back. So if funds are sent somewhere, sending them back or sending them to essentially their rightful owner. But I know that's what some of the stablecoin issuers are looking to do to prevent fraud outright. From an ACH standpoint, maybe I'll let Hal answer that question.
Yeah, when it comes to ACH, if the the typical ACH return process is like the external bank where the funds come from will initiate the ACH return, right? The ACH was not settled because of that. And then the trading platform realized, oh no, right, that was fraud. And then they're trying to recover the fund. At that point, what we heard from the trading platform is that at that point, they basically cannot do much to get the money back by asking the stablecoins issuer. Right. Once the money is there, even the issuer of the coin cannot know whether the coin still exists in the form of that coin or it's already been exchanged, right, or traded to a different coin. So typically, what the trading platform has to do is just to sell, kind of like a freeze the account, and then sell the coins that are still available in the wallet and use that money, right, based on the market value of the coins at that time to recover the loss. That's pretty much it when it comes to loss recovery.
All right, thanks, guys. Next question here. What is the biggest gap you see between what banks think they need to monitor in crypto fraud versus what actually matters?
Well, I can try to take on that one, and Kamal, please chime in too. So I can see a lot of the banks, we are still operating when it comes to fraud monitoring. It's still unfortunately quite silo. So the crypto transaction typically, right, launched by the product team might be monitored by the product team, maybe a small fraction of the fraud team in a silo way just about the crypto transaction. People are not usually linking the end-to-end journey of that transaction yet. So when it comes to where the funds come from, right? Is that coming from our existing bank account in our own bank, or is actually just funded from an external bank? And how long has that user been with us? What other transaction has the user been doing on our platform, right? Is he or she also a Zelle user on our platform? Is he an active user coming to our branch? So a lot of those user holistic activity are not being factored in yet when it comes to the crypto fraud monitoring. Sometimes maybe just look at the chargeback rate, right, or recovery. So I would see that is the biggest gap in focusing on narrowing the monitoring just onto the crypto versus getting the holistic picture about the user activity and putting that user's activity into all the other users' activity, like a bigger pool, to look at all those subtle connections that we earlier mentioned in the case studies.
Thanks, Hao. Next question we have here, we probably have time for this question plus one more. How should smaller financial institutions or credit unions with limited resources prioritize their defenses? What's the 80-20 here?
I can take on that one for now. So the 80-20 here, when it comes to what's the most cost-effective way or what's the lowest hanging fruit, I will still emphasize the importance of the KYC signals. As a FI, right, as a credit union, you're already capturing those KYC signals already. And sometimes you might be using more than one solution or one vendors, right, for the KYC signals, ID verification, digital rigs, but you are not leveraging the full value from those signals at this point, likely. I would say the lowest hanging fruit is engage a platform type solution like DataVisor to try to combine all the signals into one holistic rigs platform. And like we mentioned, we have the UML model, we have the knowledge graph that can help you use those signals to give you the bigger picture. Are you dealing with a fraud ring? Are you dealing with a botnet? Or these are individual good users? That's so low hanging fruit, right? No additional signal purchase, but just use a tool, right, to connect the dots, and that can help you feel like, hey, I actually know much more about my user base, and I can just tackle some of these largest risky user group or maybe fraud rings holistically in bulk.
Got it. Thanks, Hao. And one last question here from Rick. You mentioned bank account balance checks to prevent ACH returns. How do you manage due diligence for the originator?
Um, Let me try to understand the question. Manage the due diligence for the originator. Here, the originator is actually the trading platform. The user is actually initiating the funding, right, or the ACH pool. So originator here, especially the platform. So the platform, the trading platform, could use maybe tools like early warning, Plaid, Gaiat, right? Some of these Yardley, right? Some of these popular providers to tell you about the information, sometimes the real-time information about the the bank account that we're trying to get the fund from. So I would say that would be the due diligence about the name verification, balance check. Sometimes they provide even more additional signals about the recent activities of those accounts.
Got it, Hao. Thank you. Hao, if you just want to go to the next slide. That concludes our questions here, everyone. We're just about out of time. Thanks again for joining. If you want to keep learning between our webinars that we have on a monthly basis here, use this QR code and feel free to register for our self-paced online Defend training course. It's fully launched now, so please take advantage of it. And again, the link to our next month's webinar is in the chat. Hopefully we all see you then, and thanks again for joining.
Thank you everyone for joining. Thank you, Kamal. It was great chatting with you.
Yeah, thanks again for having me.
Thank you.